Hi there, I'm Andrea Scott and I am the CEO of AE Scott & Co Accountants. I initially started doing the accountancy as a sole trader, and then in 2013 I incorporated into a limited company. There isn't just me, I have the most amazing team possible. Certainly wouldn't be where I am without them. We all pull ourselves up and strive to be the best that we can be. We are based in the Northeast. We have over 100 clients that are purely in property. So when I say property, there's all aspects of property such as residential, commercial, holiday lets, your rent to rents, you've got your mixed use. So there's a large variety of properties in there as well. And not only that, I have my own property portfolio, very tiny. Purely because I'm helping everybody else. But I've got a residential that I've had it for about 20 years. I've got a holiday let that is in the side of a cliff. Now that had its own issues in itself, for example, no access, but that's a completely different story. We'll have to grab a coffee because you'll love those stories anyway. I'm also looking to purchase a commercial property and another residential this year as well. So I've got lots of different clients with a variety of property types as well. So we've got some that are doing rent for rents, some that have just got huge residential portfolios, some with commercial, some with mixed use. So there's a lot going on there as well, and quite a few obviously refurbs and your HMOs and things like that anyway. I have also been in the industry for 19 years and I absolutely love it. I've seen lots and lots of changes too. So one of the main things that I get asked all of the time is, Andrea, how do I know if this receipt is allowable for tax? And the one thing that you need to think of first of all is HMRC used to say that an expense, for it to be tax deductible, it needs to be wholly and exclusively for your business. Now what they've done is, because quite a few people took the mick, is they've added the word necessary, and I'll come on to that in a moment. So it needs to be wholly, exclusively and necessary for the trade for it to be a fully tax deductible expense. Now, in different trades, different expenses are allowable and some aren't. And I'll give you an example I give to quite a few people, and it generally makes sense when I go through this. So I'm an accountant. So if I was, like, the way that I have my office set up is I've got a humongous 49-inch curved gaming monitor in front of me at home, and I've got the same setup at the office. I've got my laptop at the bottom here, and I've got my iPad Pro with my little pencil thing here, and then I've got my phone. So I work from home and we work in like a digital time as such. So we don't want much paper around, so we get lots of things emailed. So for me, this works. I'm also a dyslexic as well. So for me, this really, really works because I'm working on about 10 different screens at a time. So for me, it's wholly, exclusively and necessary. It makes me more efficient as an individual. Now, if a hairdresser, for example, wanted to buy a big 49-inch screen, HMRC would be like, is it really necessary for what you do? Whereas me, when I buy scissors, I will get mine for £1, £2 from IKEA. Whereas when you're looking at a hairdresser, for example, especially when you're looking at where their business is and needs to go, you see, when you're a hairdresser just starting out, you might opt for a pair of scissors that's 40, 50 quid, for example, and that's necessary at that time, and usually that's all the hairdresser can afford. And then when you become more established and you get more experience, then 150 quid for a pair of scissors isn't like frowned upon because it's good for that trade. So as you can see, there's 3 different pair of scissors here, but they're all deemed to be different in comparison to the type of business that it's running on. The hairdresser couldn't get the same setup as me, but I couldn't get the same setup as her. And it's also when they've started and where they're at now as to whether that's still deemed to be an appropriate charge. So always like get clients coming to me saying, Andrea, I was down the pub the other day and I might grab a cuppa, let's see what was discussed. And they'll say, so-and-so can claim this. And then I'd be like, are they a plumber? And they're like, yeah. And I'm like, are you a plumber? And they're like, no. And I'm like, that's why they can claim that, because it's necessary for their trade, where it isn't for yours. So for example, like architects, might work more from home, so they'll be able to claim more of the use of home allowance, for example, in comparison, like if they were both sole trader, in comparison to a plumber, for example, who's generally out all day every day, and they might be at home working from home for a couple of hours on an evening or a weekend, whereas an architect might be 9 till 5 or even longer hours all day every day. So there's lots of things to take into consideration about wholly exclusively necessary, where you're working, what you can claim. And then the other aspect of that as well is the information still valid and correct? Because when people do come to me and they say, Andrea, is this correct? I'm like, yes, 3 years ago. So it's not now. So you need to make sure that all of that data, and believe me, it changes all of the time. You need to make sure that it's constantly up to date as well. So yes, your friends down the pub might be correct in what they say. It might not be relevant anymore, but they were still correct. They just haven't been updated themselves. And then for the receipts that they can claim, yes, they are correct, but you might be in a completely different trade. So it's working out all of that. So the best way to do that is speak to your accountant and just, don't think, oh God, I can't ask them again. Because we would rather you ask the question, you go away feeling more confident, you then explain that to your friends, you're all confident together and everybody's happy. So for example, what I generally do is I'll take myself out of the business more, again, because of my fantastic team, and up on one of my screens, because I'm working on about 10, I'll have a communications board. So I've got my WhatsApp, I've got my texts, I've got my Teams, I've got my emails, I've got the Messenger. So after a meeting, I'll then go through all of the questions, because it'd be like, Andrea, I'm looking to buy this car. How shall I buy it? I'm looking to get this. Is it tax deductible for me? And then I'll just go through all of those, and everybody's really, really happy. Hopefully they are anyway. I think they are. We get great feedback. Speaking of which, take a look at our feedback as well. I'd love you to see it. Anyway, moving on. Okay, so we've discussed what an allowable, if I can get that out, deduction is in any business. So now let's focus more on the property side. So if you are looking to have a property business, the next question is, how do I buy the properties and in which entity? And by entity, I mean, are you buying it as a sole trader? Are you doing it as a partnership? Or are you doing it as a limited company, part of a group structure? Or even, that property, is that held 40% by you as an individual and 60% by a limited company? Now that structure is more high level and there's lots of anti-avoidance rules. So that's a completely separate video, because it's not needed for people who are just starting out essentially. So let's talk about sole traders, partnerships and limited companies. Before we even decide whether we're going to be a sole trader, partnership, limited company, there's a few other areas that we need to assess. So one of them could be, are you a basic rate taxpayer, higher rate taxpayer, even an additional rate taxpayer? Do you need a mortgage on the property? If so, is it going to be a large mortgage? Because the capital side, so like if it's not an interest only, so obviously when you get a mortgage, you've got your capital repayment. So capital repayment, if buying via a limited company, partnership, individual, the capital part isn't an allowable deduction against profits anyway. It's just the interest. Now in a limited company, the interest is currently fully tax deductible amount, whereas if it's held personally or in a partnership, you can only get a 20% deduction. So I think it's on like £4,000 at 20%, you're going to get £800 deduction from the tax itself. So when you've worked out all of the tax payable, then you'll get that deduction of £800 on there. So that's obviously when you're looking at the mortgage side of it. if you're going to look to buy in a limited company, will that profit from that business increase the profits above £50,000, which then goes into the marginal rate tax bracket, which basically means that you're going to be paying between 19 and 25% corporation tax. So when you look at that figure compared to if you're a basic rate taxpayer of 20%, the figures start to differentiate. So you need to look at obviously where your profits are. Are you looking to pass the property down to children eventually? You know, what's your 5 to 10 year plan? How old are you? Because, you know, if you're, I know there's just so many examples, like, you know, if you're getting on for 60, 70, you've got quite a few grandchildren, and everything is held personally, you know, should we be gifting those properties or moving them over to a trust potentially, or, you know, into a limited company? Now, obviously, I don't want to go too much into that, because then, you know, if you're then selling, that again, selling of properties is a completely different video. But again, age and your plan is really, really important when you're looking at the starting point of it. You know, where do you want to be? Another one is, do you need the cash now, or can you leave it in a limited company? So if, say for example, if you've got profits personally, you're taxed on them regardless of whether you reinvest or take it personally. Whereas if that's in a limited company, you just pay the corporation tax, and providing that you don't take it out personally, there's no dividend tax to pay. Now, in a limited company, for example, and this is what I do with my property investment company, is I'll just add to my pension, so that I don't pay any corporation tax. So I've got my trading company, which is AE Scott & Co Accountants, and then I've got AE Scott & Co Holdings, which has got my investment properties. So I've planned this, so I'm not, hopefully, unless I do really, really well, I'm not going to be paying corporation tax, because all of the profits in there I'm going to pay into my personal pension, because it is a tax deductible event, because I work in the business as well. So there's ways around getting of not paying the corporation tax, obviously legally, of course, that we can work on as well. Whereas if you need the physical cash and you're a basic rate taxpayer, it might be best off holding that personally as opposed to in a limited company, because then you're going to be looking at corporation tax plus dividend tax, which is actually just increased again. Well, not again, it's just increased for people in property. So that's a bit of a kick in the teeth. And do you already have a pension pot? So there's those type of questions that we need to know, and everybody's different. So what I will give advice to one person will be completely different to another, because their circumstances are completely different. So I hope that makes sense. It's not a one route or package, or whatever the saying is, that meets all. You're all different. You're all at different stages of your life. You're at different stages in property. You're all just different. So you all need your own personal plan. Moving on. I guess now what we need to discuss is the fact that tax is always changing. I can be working, or me and my team can be working 20 years previous, especially when it comes to property let and people who haven't been declaring their income, and then they come to the likes of us to sort everything out. And we can also be working in 5 years in the future as well. And things change all the time. So we might be doing planning now. For example, when I was doing the planning for my holiday let, I'd went to buy the property and everything, and then the whole furnished holiday let regime just cancelled from the following tax year. Thankfully for me, I'd got it in the limited company, so it didn't really impact like the main issues, which I'll come on to a bit later on. But the point I'm trying to get is things are always changing. I suppose that goes back to the right at the beginning, where it's like you need to have somebody who's keeping you up to date, or you need to be keeping up to date yourself. So I think now what I'll do is I'll go over a few changes that have happened in the past that have changed, just so that you get an idea, and then you can take all those all that information to the pub and tell your friends if you so wish. Anyway, here's a few. Mortgage interest relief. So originally, back in the day, as I say, because I've been doing it all along, mortgage interest was fully deductible. So if you were on an interest-only mortgage and the interest was for the year £4,000 and your rental income was £6,000, and we're just taking those into consideration, let's make it simple. So you've got your £6,000 income less your £4,000 interest, then you were taxed on the £2,000 at whatever rate as an individual, let's say, so 20, 40, 45%. That was how you were taxed. Then what happened is HMRC brought in, it's like a staggered version, so you could get 100%, then 80%, and then obviously now it's gone all the way down, and you can now only get the 20% deduction, and you don't even get it in the actual accounts itself. It's done later on, further down in your actual tax return. So basically what happens is that £6,000 of your income, you're taxed as that in this scenario, because we know you'll have other expenses in there. But you're taxed on that, and then you'd get that £4,000 times 20%, £800. That's tax deducted from the actual tax bill itself. So in your tax return, for example, your self-assessment 100, SA 100, you might have your PAYE income and then your profit from property, and then you would work all of that out based on everything together, and then obviously you'd get that tax deduction of 800. So you don't get that anymore. Now you still do get the whole interest deduction in a limited company though. So that's that one. Furnished holiday let changes. So originally, if you were running a furnished holiday let, it was seen to be like a trading business. So you could get capital allowances, you could get pension credit, you can get pension credits on there. And when you sold it as a business, as a going concern, so you sold the business like it was still going, so you sold the whole thing and the goodwill and your client list and things like that, you could also claim what used to be called entrepreneurs relief, which is now called business asset disposal relief. You can't claim any of those now, and you don't get your pension credit. So, and it's now treated as a long-term rental, so it's like your normal rentals as opposed to a business. So that's been a bit of a kick in the teeth. You can claim, so you can't claim the initial, so say for example you're just starting out now and you buy a bed for the holiday let, you can't claim the initial bed via a limited company or as an individual. But what you can claim is the replacement item of that bed. So say for example in a couple of years it breaks or whatever, you can claim the replacement only. So it is a bit of a kick in the teeth, because if you're spending a couple of grand setting up a holiday let, for example, you're not going to be able to claim everything that you've spent. Making tax digital. So if your profits were over £50,000 in the tax year 24-25, then you will need to start making your MTD returns from the 6th of April 2026. If the profits were above 30 grand, you need to start making your making tax digital submissions from the 6th of April 2027. And if your profits were above 20 grand, we're going to hear about what you need to do in due course. So income tax percentile changes, which are very, very recent. So for quite some time now, the income tax rates were 20, 40, 45%. However, if you've got rental property income, that will go to 22%, 42% and 47%. So HMRC, the government, don't want us in property, or if we do, we're going to be getting taxed more, and that's on the individual basis. Now, if you have an an investment company, so you get dividends, it used to be 8.75%, and they've all been added by 2% as well. So it's gone from 8.75% to 10.75%. It was 33.75%, and now it's 35.75%, and the 39.35% hasn't changed. So that's the only one that hasn't changed. It hasn't changed. So it is a bit of a kick in the teeth, because we do now have to pay more tax if we want to be doing property. I'm not sure if that's going to stop you, or whether if you're in a limited company, for example, you might end up putting more into your pension. And there's different rules about pensions as well, so you need to be working within the business in order to claim that expense. But then, you know, that's where you'd ask me different questions, or you'd ask your accountant questions, and they would get you set up in the right way in accordance to how you need to run your business, and obviously your priorities, going back to what we were talking about earlier on about your own personal journey. And other issues are the likes of mansion council tax, councils in particular areas that you live in, where they're charging double and sometimes triple council tax for unoccupied houses, or second homes and things like that. Now, these types of council tax or extra taxes that we have to pay are dependent on where you live, and obviously where the property is, essentially. So you'd need to make sure that you are on top of all of that. For example, with my holiday let, I'm in the process of changing that over to business rates, and hopefully I'll get business rates relief. But I have been given a double council tax payment to make, and I have appealed that and advised that during that time it was was being completely renovated. So they've then asked me for before and after pictures, so that they can confirm that I am in fact telling the truth on that one. So there's lots of other things going on there as well. Another area to think about is if you're buying in your own name, for example. So we've done all of the analysis right at the beginning, and for you it was better to put it in your own name. If you are deemed to be trading, so that means that if you were literally flipping properties over and over, you're buying and selling, and it isn't classed as an investment. So if you buy a property, you hold it for a good few years, that's an investment property. Whereas if you were just doing lots of flips, that becomes a trading property. And what that means is, if you've got a trading company, you pay income tax of the new 22, 42, 47%, whereas if it's an investment company, then you will pay the capital gains tax, which is a lot lower. So you're looking at your 18% if you're a basic rate taxpayer, 24% if you're a higher rate taxpayer. So as you can see, the decision on how you then look to keep those properties may be depending on, like, if you are looking to flip a few, it might be best off being in a limited company. Again, depending on the profits. So it's going back to the initial, what's your plan? And things can change, but HMRC do look at the frequency of these transactions in order to establish whether you are actually a trading business, or an investment business. So that's something else to look into as well. Now for VAT. So generally on residential lettings, VAT isn't added, it's exempt. However, if you're doing a new build, or you've got commercial property and there's been an option to let, or you've got mixed use properties, so there's a part residential and you've got your commercial, there may be VAT implications in those aspects of it. Another thing is a hotel, for example. So you will book with the likes of Premier Inn, there'll be VAT in there, and a holiday let is classed the same as a hotel in the VAT. So for the trading side of it, so for sales side of it, and your income side, once your income in that entity. So if you've got a few properties, a few buy-to-lets, for example, in the limited company, if that reaches, well, 90 grand, you're going to have to go VAT registered. But if you've got some property lets in the business and then you've got some residentials in there as well, which are exempt, you're going to have a partially exempt business for VAT. So you can't claim everything. You can only claim the VAT that's applicable to the property let side of it. Or if you've got a commercial building in there, you know, it just depends on whether you've opted to VAT in there as well. So there's always things to look into for the VAT, and this is why some individuals may put all of like the commercial and the holiday lets into one type of limited company, and then, you know, others either held personally or in another limited company. So there's VAT as well, potentially, depending on your own personal situation, I suppose. And then we have group structures. So say, for example, you and your husband or wife, you've got 50% each of a holdings company, and then that holdings company may hold different companies as well. So say, for example, if you go into a joint venture with somebody who isn't connected to you, and or they're doing investments, or you're doing a project with them, you'll want to keep that completely separate to you yourself and any other companies that you have as well. And the reason for that is the individual company, they potentially want to get all of their profits out of that company as soon as, which basically forces you to have to do the same. If, say, for example, you're going to do a joint venture where the profits are 50-50, you're then forced to take the profits out. Whereas if you're part of your own group structure over here, then those profits can be shifted into one of your other limited companies, and you don't necessarily have to take those personally, because it can just be shifted around your personal group. Now, don't start setting up group structures to try and save on a little bit of tax, because the more companies that you have, the more accountancy fees. And there's also something called, like, with this marginal rate relief. So earlier on, I mentioned that if your profits exceed 50 grand, you've got a higher corporation tax rate, and then you get a little bit of a relief. So you're technically taxed at 26.5%, but then because of the relief that you get, it comes under the 25% overall tax that you're going to be charged. But if that's only based on one company, so if you have two companies, that 50 grand is then split. So the more companies that you have that you have got more than 51%, well, more than 50% control of, it's going to impact on your profits potentially. So if you've got a few companies where, you know, you've got 3 or 4 where they're making 5 grand profit because you want them to keep everything separate, and then you've got another couple that are in the 48-45 grand, for example, that 50 grand is divided by all of those 5 companies. So when you get to the 10 grand, that's when you're going to start paying the higher rate corporation tax. So this is another thing that we need to look into. So it's marginal rate relief. How are you going to be set up if it's going to be a group structure? And is it really necessary? It will be if you're working with other people that aren't connected, but is it really necessary for your long-term goals? So yes, group structures do work, they are valuable, however, only in the right context. Now, you may have seen that there's a good few years ago, and this is before the marginal rate relief came in, is everybody had lots and lots of different companies, and now you'll see that they're all merging because it's just not tax efficient anymore, and you're just paying the higher rate of tax. So it's just working with what taxes we've got. I'd now like to share a few examples that we have been working on in the last few weeks. So here goes. The first example is I had a couple that had been divorced some years ago. They come to see me because they'd both received the same letter from HMRC saying that they believed that they both owed HMRC income from property in some way. It was quite vague, didn't go into any detail. And what this was, it's essentially not, well, it is a phishing letter. They know that there is some income there, but they just don't know what. And my advice here, and it always has been, always will be, I did not get a detention at school. I didn't even swear in the street. But anyway, that's another story. Always tell the truth, because HMRC have means and ways in finding out the information, like council tax, the electoral rolls, the bills. They've got access to a lot more than what you know. So always straight down the line, tell the truth, do what you need to do, do what you need to do, get all of the information. But anyway, going back to this, so they both came into my office and they said, oh, we've both received this letter. And I was like, do you have any rental income? To which they replied, yes. And I was like, okay, how many? And they'd said, one. And I was like, okay, how long have you been renting it out? And it was like getting on for 20 years. And then it was sold. And then something just didn't feel right. So I'd said, look, if there's more than one, or if you're not telling me everything, what happens is I would do the return based on the information that you've sent me. It will go to HMRC. They will look into it and then they will write back and say, we feel that there's more. They're not going to tell you which addresses they have on file. They will just keep letting you dig and dig and dig. So be open and honest all the way through. So anyway, I'd done a quote. They went away. They came back to me. They said, we're just going to leave it. We don't really have any information. We're just going to see what happens and let them decide the tax. To which I replied, you're well within your rights to do anything, but I wouldn't. I'd put everything in and just go from there. Anyway, it turns out in this instance, there was 8 houses over 20 years, over 300 grand's worth of income coming in. If they had only done the one house or didn't do anything, HMRC would have put lots together. It would have went on a lot longer, and that's before any interest. So basically here, so you've got over 300 grand's worth of income from all of these houses for the last 20 years, no capital gains paid or anything. It's a high bill, if I'm completely honest with you, but we've mitigated the amount of penalties. Now HMRC, if they kept asking and the information wasn't provided or the information was withheld, the penalties can go up to 100% in this case. So if their tax bill was like 30 grand, you're going to get 30 grand potentially worth of penalties as well as the tax that you need to pay. And in addition to that, there's also interest from day one. So from 20 years ago when you owed that tax, the interest is accruing to now, today's date. Now, luckily, the interest rates have only in the last few years increased quite dramatically, if I might add. They were always like 2 to 3%. But now they've obviously gone up to like your 7, 8 back down, and like they do fluctuate a little. So for these, obviously we're working on that property let campaign, and obviously we've sent the initial figures for the 8. For this situation, it's the income tax first of all, then it'll be the capital gains tax because all of those properties have now been sold. Then we'll be looking at the interest, and then we try and get those penalties down as much. But in the penalties, HMRC will also ask, why didn't you tell us, or why didn't you submit this? And there's only very few reasons that you can get away with as to why. Now obviously for 20 years just saying I didn't know about it, they're probably not going to get away with that. So that's one of them that I wanted to sort of bring to your attention. So another case was a property was passed down by generation, and eventually it went to a brother and sister. Now, the brother lived in that property as his principal private residence, and the sister moved out, had a child, lived a life, and never gained anything from that property whatsoever. Then that property was gifted to her daughter, and because of that, she thought, rightly so to be fair, because who would know otherwise, that there was no capital gains or anything to pay, because she'd never actually got anything out of the property. There was no rents exchanged or anything like that. Like, this house went so far back, it was bought in shillings. Like, I hadn't even worked on documents that old until this time. But anyway, that's another story. So HMRC, well, it was only when we were doing other things with this case that when I was retrieving the information, it was like, oh, where's the capital gains tax? Because what happens then for capital gains, if you don't live in a property that you own, so it's not your PPR, which is principal private residence, that's an investment property. So you would actually pay capital gains tax on the profits from that, whether you gift it to somebody else or sell it at a later date. Not many people know this, and it's something that's, more common where properties have been handed down over generations. So in this case, we had to get all of the tax, all of the capital gains and everything up to date. And in this case, we did actually go to HMRC to appeal the penalties and interest, and they have actually said, do you know what, yeah. So this was one of those ones where they were like, yeah, that's valid. You didn't actually make anything from it. You've paid all of your tax when you've said you had. We didn't prompt you at all. You've had a word with your accountant. She said, look, this should have been paying. As soon as that was highlighted, HMRC were contacted, the funds, because it was a lot of money, a lot of tax that was got, and then it was paid over to HMRC. So in the eyes of HMRC, they were like, they didn't know, clearly didn't know. They've got the tax, they've paid it. Jobs are good 'un, essentially. So there was a lot of tax to pay, but she completely didn't know, and HMRC did have a sympathetic side in this instance. So that was another property area that we've been working on.